You are looking at the title slide for Goldman Sachs second quarter 2026 earnings results presentation. This material was released on July 14, 2026, and is intended to communicate the company's financial performance and key business developments for the quarter. The following content will provide an in-depth analysis of Goldman Sachs' performance and market outlook. The most noteworthy section in this presentation is the results snapshot, which summarizes Goldman Sachs' second quarter performance. Looking at net revenues, the second quarter figure stands at $20.338 billion, with the year-to-date, YTD, total reaching $37.565 billion. This indicates a considerably robust growth compared to the same period last year. Moving on to net earnings, the second quarter shows $6.628 billion, and the YTD total is $12.258 billion, mirroring the positive trend seen in net revenues. Earnings per share, EPS, metrics are $20.98 for the second quarter and $38.51 YTD, likely surpassing market expectations and serving as a crucial indicator of the company's profitability. Furthermore, the annualized return on equity, ROE, is 23.5% in the second quarter and 21.7% YTD, demonstrating high profitability relative to equity, while annualized return on tangible equity, ROTE, also shows excellent performance at 25.5% in the second quarter and 23.4% YTD. Book value per share is $367.67, with a YTD growth of 2.8%, indicating that the company's intrinsic value is also steadily increasing. The quarterly highlights section provides specific details supporting these financial achievements. Notably, both record net revenues and diluted EPS are approaching their highest levels ever. Net revenues in the Global Banking and Markets (GBM) segment, including record intermediation and financing and debt equity financing, have reached an all-time high. The company also secured the number one position in M&A, equity and equity-related offerings, and leveraged lending, and ranked number 2 in high-yield debt, once again proving its strong competitiveness across key business segments. Management and other fees also performed well, and record asset under supervision, AUS, of $4.04 trillion shows a stable revenue structure with 34 consecutive quarters of long-term fee-based net inflows. Finally, the company has decided to increase its third-quarter dividend by 11% to $5 per common share, which is a positive signal reflecting the company's strong cash flow and commitment to shareholder returns. Let's begin by examining the financial results. Net revenues for the second quarter of 2026 reached $20.338 billion, representing a 39% year-over-year increase. The Global Banking and Markets segment was the largest contributor, with revenues of $15.520 billion, showing a significant year-over-year rise despite the reflection of losses related to wholesale loans. The Asset and Wealth Management segment contributed $4.597 billion, up 20%, while Platform Solutions saw a 64% decrease year-over-year, amounting to $221 million. Provisions for credit losses decreased by 73% year-over-year to $102 million, which can be seen as a positive indicator. Operating expenses increased by 26% to $11.673 billion, a result of a combination of improved operating performance and increased transaction-based expenses. Consequently, pre-tax earnings surged by 73% to $8.563 billion, and net earnings increased by 78% to $6.628 billion, demonstrating robust profitability. Diluted earnings per share, EPS, rose by 92% to $20.98, and return on equity, ROE, improved by 10.7 percentage points to 23.5%, indicating a significant enhancement across all key financial metrics. The Global Banking and Markets segment demonstrated robust growth, with net revenues reaching $15.52 billion in Q2 2026, a significant 53% increase year-over-year. Notably, all key business areas showed double-digit growth, investment banking fees surged by 55% to $3.39 billion. FICC revenues grew by 32% to $4.59 billion, and equities climbed by a remarkable 72% to $7.41 billion. This impressive performance is largely attributed to enhanced equity underwriting and advisory services, alongside expanded fixed income intermediation and financing. Furthermore, net revenues saw a 22% quarter-over-quarter increase, reflecting a positive market recovery. The segment's total assets stand at $1.88 trillion, with a loan balance of $188 billion and net interest income of $2.62 billion, indicating a stable financial position. This strong performance suggests continued growth potential moving forward. Let's examine the net revenues for the Global Banking and Markets segment. In Q2 2026, total net revenues reached $15.52 billion, marking a significant 22% year-over-year increase and an impressive 53% sequential growth from the previous quarter. Notably, investment banking fees generated $3.39 billion in net revenues, a substantial 20% year-over-year increase and a 55% sequential rise, largely driven by increased merger and acquisition volumes across the industry. Equity underwriting also demonstrated explosive growth, with net revenues of $985 million, up 84% year-over-year and 130% quarter-over-quarter. Debt underwriting followed suit, posting $1.032 billion, a 27% year-over-year and 75% sequential increase. The FICC segment contributed $4.592 billion, a 14% year-over-year and 32% sequential increase, with FICC intermediation alone bringing in $3.376 billion, up 14% year-over-year and 39% sequentially. Equities intermediation saw robust performance with $4.157 billion in net revenues, a 53% year-over-year and 60% sequential increase. These positive results reflect strong market activity and high demand for financial products during the period. Let's first examine the financial results for the Asset and Wealth Management segment. Total net revenues for the second quarter of 2026 reached $4.597 billion, marking a 20% increase year-over-year. This growth was primarily driven by higher management and other fees, propelled by an increase in average assets under management. Investment-related revenues saw substantial growth, rising 222% to $441 million, fueled by significantly higher net gains from investments in private equities. However, revenues from private banking and lending declined by 13% to $689 million compared to the previous quarter, reflecting a lower net interest margin related to Marcus deposits. Operating expenses amounted to $3.458 billion, an increase of 15% year-over-year. Considering these factors, pre-tax earnings for the second quarter of 2026 stood at $1.112 billion, an increase of 22% year-over-year, indicating robust growth. Net earnings also rose by 24% to $856 million, sending a positive signal to the market. First, let's examine the total assets under supervision, or AUS, for the Asset and Wealth Management segment. In Q2 2026, AUS reached a record $4.04 trillion, an increase of $391 billion from the previous quarter. By asset class, net inflows in liquidity products and equities were the primary drivers of this growth. Notably, long-term AUS increased by $272 billion from the prior quarter to $2.724 trillion. This was driven by $91 billion in net inflows and $161 billion in net market appreciation. The breakdown of long-term AUS net inflows shows $1.25 billion from the institutional client channel, $1.04 billion from the wealth management client channel, and $680 billion from the third-party distributed client channel. Turning to the regional breakdown of AUS, the Americas accounted for the largest share at 73%, followed by EMEA at 20% and Asia at 7%. In terms of investment vehicles, separate accounts represented the largest portion at 53%, with public funds at 29% and private funds and other at 18%. Taken together, these figures indicate that the Asset and Wealth Management division continues its strong growth trajectory, with institutional clients and separate accounts being key drivers of this expansion. First, let's examine the on-balance sheet alternative investments table. As of the second quarter of 2026, total alternative investments on the balance sheet amount to $25.9 billion, comprising loans of $5.4 billion, debt securities of $7.3 billion, equity securities of $11.4 billion, and others at $1.8 billion. It is noteworthy that equity securities represent the largest portion. Next, the Alternative Investments AUS and Effective Fees table presents the AUM and fee rates. The total alternative investment AUM reached $44.5 billion, with corporate equity at $13.1 billion, credit at $7.9 billion, real estate at $2.6 billion, and hedge funds and others at $7.2 billion based on average AUM. Furthermore, funds and discretionary accounts account for a significant $30.8 billion, with an average fee rate of 78 bps for this segment. The alternative investments highlights show that in Q2 2026, fee income from alternative investments increased by 22% year-over-year to $725 million, and alternative investment AUM grew by $30 billion to $459 billion. Additionally, during a period when a total of $523 billion has been raised since 2019, the gross third-party alternatives fundraising in the quarter reached a record $59 billion. Finally, the alternatives fundraising stacked bar chart illustrates the breakdown of alternative investment fundraising in Q2 2026. A total of $59 billion was raised, with corporate equity accounting for $16 billion, credit for $31 billion, real estate for $3 billion, and hedge funds and others for $9 billion. This data indicates the overall growth trend in the alternative investment market, as well as investor preferences for specific asset classes. First, let's look at the financial performance of the Platform Solutions segment. Net revenues were $221 million, a 46% decrease year-over-year, and a 64% decrease compared to Q2 2025. This decline in net revenues appears to be primarily due to net markdowns related to the Apple Card loan portfolio, which was transferred in Q4 2025. The provision for credit losses decreased by 100%, and operating expenses were $269 million, an increase of 20% year-over-year and 21% compared to Q2 2025. Pre-tax earnings were a loss of $48 million, showing a not meaningful ENM figure compared to the previous year, and a 66% decrease from Q2 2025. Net earnings also showed a loss of $43 million, with a not meaningful ENM figure year-over-year and a 65% decrease from Q2 2025. Net earnings to common were a loss of $50 million, not meaningful ENM year-over-year and a 43% decrease from Q2 2025. Average common equity was $3,425 million, an 8% decrease year-over-year and a 23% decrease from Q2 2025. Finally, the return on average common equity was 5.8%, a decrease of 12.1 percentage points year-over-year and 2.6 percentage points from Q2 2025. The graph clearly shows that net revenues for Q2 2026 were $221 million, a significant decrease from $411 million in Q1 2026, and also a substantial decline when compared to $619 million in Q2 2025. This slide presents information on loans and net interest income. The table on the left details loan balances by type for the second quarter of 2026, the first quarter of 2026, and the second quarter of 2025. Notably, Other collateralized loans are the largest category at $109 billion, showing an increase from the previous quarter. Corporate loans, at $35 billion, represent a significant portion, despite a slight decrease from the prior quarter. Total loans stood at $261 billion in Q2 2026, an increase from $253 billion in the preceding quarter. The Loans and Net Interest Income Highlights section on the right indicates that loans increased by $234 billion in Q2 2026 compared to the prior quarter, demonstrating consistent growth quarter over quarter. Furthermore, net interest income for Q2 2026 was $3.95 billion, a 27% increase year-over-year, attributed to an increase in interest-earning assets and a decrease in funding costs. The bar chart loans by segment at the bottom right shows that the total loans of $261 billion in Q2 2026 are comprised of $188 billion from global banking and markets, $53 billion from asset and wealth management, and $20 billion from platform solutions, providing insight into the diverse composition of the loan portfolio. This slide analyzes the total operating expenses and efficiency ratio for the second quarter. As you can see from the table, total operating expenses in Q2 reached $11,673 million, a 26% increase year-over-year. Notably, compensation and benefits expenses rose by 30% to $6,104 million, reflecting improved overall operating performance. Transaction-based expenses also increased by 56% to $3,052 million, and non-compensation expenses climbed 19%, driving the overall rise in costs. Meanwhile, the year-to-date effective tax rate for Q2 stood at 18.5%, a 1.7 percentage point increase compared to the same period last year. This is primarily attributed to a decrease in tax benefits from the settlement of employee share-based awards, partially offset by an increase in other permanent tax benefits. The efficiency ratio on the right shows that the year-to-date efficiency ratio for Q2 was 58.8%, an improvement compared to 62% in the same period last year. These changes in the cost structure and the trend of efficiency improvements are expected to have a significant impact on the company's future profitability. This slide presents an overview of our capital and balance sheet. Looking at the key metrics under capital, the standardized CET1 capital ratio stood at 12.9% in 2Q26, a slight increase from 12.5% in 1Q26, though lower than the 14.3% recorded in 4Q25. The advanced CET1 capital ratio also increased to 13.7% in 2Q26 from 13.3% in 1Q26, while it saw a slight decrease from 15.1% in 4Q25. The supplementary leverage ratio, SLR, decreased to 4.3% in 2Q26 from 4.7% in 1Q26, and is also lower than the 5.2% in 4Q25. These capital adequacy ratios are showing movement in line with market dynamics. Moving to the selected balance sheet data, total assets reached $2,128 billion in 2Q26, up from $2,060 billion in 1Q26. Deposits were $558 billion in 2Q26, a slight decrease from $561 billion in 1Q26. Unsecured long-term borrowings increased to $348 billion in 2Q26 from $315 billion in 1Q26. Shareholders' equity remained stable at $123 billion in 2Q26, consistent with 1Q26. Average GCLA increased to $555 billion in 2Q26 from $494 billion in 1Q26. This data indicates an expansion in the company's overall asset size accompanied by increased borrowing. Finally, examining the book value section, basic shares per share were $298.40 in 2Q26, a slight decrease from $302 in 1Q26. Book value per common share rose to $367.67 in 2Q26 from $361.19 in 1Q26. And tangible book value per common share also increased to $336.61 in 2Q26 from $336.28 in 1Q26. This suggests improvements in shareholder equity-related metrics, which can be interpreted as a positive signal for investors. Overall, the company's capital soundness and asset size are on an upward trend, with shareholder value also showing improvement.